Welcome to the deep dive.
Glad to be here.
Today we're taking a closer look at Pool Corporation. Ticker's Pool.
Right. Pool.
Yeah, it's this company. It had this massive surge, during the pandemic. Everyone was building pools.
Absolutely. A huge demand spike.
But now things are different. They're calling it post-pandemic normalization.
Mm-hmm. A return to, well, something more normal, supposedly.
So our mission today really is to unpack that. What does this transition actually mean for Pool Corporation? Is it just fading back, or is it becoming something else, something more stable?
And we'll be digging into, all the details. We've got the fundamentals, financials, what analysts are forecasting, and even broader market sentiment, trying to piece together a clear picture of what's really going on.
Okay, let's jump right in then. Growth seems like the obvious place to start because, wow, what a change.
It really is.
During, 2020 to 2022, the sources say they saw unprecedented demand.
Yeah, it was fueled by, well, a perfect storm, wasn't it? Low interest rates.
Right. Everyone doing home improvements.
And just being stuck at home looking at their backyards.
Exactly. Yeah. But that environment, it didn't last.
No, definitely shifted.
Yeah.
We've got higher interest rates now. Inflation is hitting consumer spending. And that's brought in this this normalization period for Pool Corp. The boom, well, it had to level off.
And the numbers really show that contrast, don't they?
Struggling.
So historically, fiscal 20 through 24, revenue growth averaged 11.2%. Pretty solid. Got a 3-star rating for that.
Not bad at all for that period.
But then you look ahead. The forecast for 25 through 27, it drops a lot.
Yeah.
Down to 3.1%.
Yeah, just a 2-star rating there. It's a significant slowdown.
So what's the deal? Does this mean the company's in trouble?
Well, that deceleration leads to an overall weak growth rating, the 2 stars. But, and this is really interesting, it's absolutely not a sign the business is failing. Not at all. What's happening is that the growth driver is changing completely.
How so?
It's now all about their vast installed base of pools, the ones already out there.
Ah, okay.
Think about it. Something like 65% of their sales, that comes from maintenance and repairs, stuff people have to do.
Right, the non-discretionary stuff, chlorine, filters, fixing leaks.
Exactly. So even if new pool building slows way down, and that's only about 15% of their sales anyway,
right,
all those existing pools still need upkeep, millions of them.
So it's more resilient than just looking at that headline growth number might suggest. Less glamorous, maybe, but steadier.
Precisely. The whole investment thesis, you kind of have to recalibrate it.
Yeah.
It's not that high growth story anymore. It's morphing into something different. A stable market-leading compounder just in a lower growth world. It's a marathon now, not a sprint.
Okay, so growth has slowed but shifted. What about profitability? They've historically been, exceptionally profitable.
Right, best-in-class margins, the sources say.
But can they keep that up? If sales growth is moderating, doesn't that usually squeeze margins? Seems like a tough balancing act.
That's the key question, isn't it? And the analysis shows kind of a tale of two margins. It's fascinating. So first, let's look at gross profit margin. This is held up remarkably well. It's stable, near 30%.
Wow, okay. Even with the slowdown.
Yeah, which tells you they have significant pricing and purchasing power. They deal with 125,000 wholesale customers, 200,000 products. They have leverage.
So their suppliers, their customers, they don't have many other places to go.
It seems that way. It points to real strength in their market position. That gets a top 5-star rating.
Got it. But you said two margins. What's the other side?
The other side is the operating profit margin, and that has seen some pressure. It peaked in 2022 at 16.6%, and it's compressed down to 11.6% in 2024.
Okay, why the difference? Why is that one getting squeezed?
It's mainly down to something called negative operating leverage.
Explain that.
Well, think about it. When your sales volume goes down or grows much slower, your fixed costs don't shrink at the same rate. Things like SG&A selling, general administrative costs.
Like rent, salaries.
Exactly.
Yeah.
Especially sticky costs like wages, which have seen inflation. So you have a smaller revenue base trying to cover relatively stable or even rising overhead.
Ah, so that squeezes the operating profit. Makes sense.
Precisely.
But even with that compression, the overall profitability picture still sounds pretty decent.
Oh, absolutely. The metrics are still strong. You look at the 5-year average net profit margin, it's 10.0%.
Okay.
And return on invested capital, ROIC, That's a healthy 21.5%.
And ROIC, that's a key indicator, right?
A very key indicator. Having these high returns on capital, consistently higher than their cost of capital, that's a classic sign of a strong competitive moat.
Like a barrier protecting your business.
Exactly. It makes it hard for competitors to really challenge them effectively. So despite the operating margin pressure, overall profitability still gets a good 4-star rating.
Okay, so growth is normalizing. Profitability is holding up reasonably well thanks to that gross margin strength. What about the foundations? The balance sheet.
Yes.
The source calls it a fortress balance sheet. Big claim. Does it hold up?
It really does seem to. They were in a pretty conservative ship, financially speaking.
Okay.
Looking at solvency, debt to equity is stable, around 1.1x. That's prudent.
Mm-hmm.
And the interest coverage ratio, exceptionally strong. It's consistently been above 14x.
Meaning they earn 14 times what they need for interest payments.
Correct, even with operating income dipping a bit. And debt to EBITDA is also very low, 1.4x. These metrics all get high marks.
What about liquidity? Short-term health.
Also looks good. The current ratio is stable, healthy, averages 1.78x. Plenty of current assets to cover current liabilities.
Okay.
Now, the quick ratio is below 1.0, but that's actually pretty typical for this kind of business. Distributors carry a lot of inventory.
Right, so you wouldn't expect that ratio to be super high.
Exactly. It just shows they manage their working capital consistently.
You know, there was a really fascinating detail in the analysis about cash flow.
Yes, the cash conversion.
Yeah? It said cash flow is markedly more resilient than its earnings. How does that work, especially when earnings were down?
This is one of those aha moments, I think. It really shows the underlying engine here. So in 2024, net income fell, right, by 17%.
Yeah.
But their net cash from operations, it was a powerful $659.2 million.
Wow.
Which works out to an impressive cash conversion rate of 152%.
152%. So for every dollar in profit they reported?
They actually generated $1.52 in real operating cash.
That's incredible how...
It highlights how efficiently they manage working capital and maybe some non-cash charges in the earnings number. But the bottom line is the cash generation is incredibly strong, stronger even than the profit number suggests. It shows real underlying resilience.
And that strong cash flow must be what powers their returns to shareholders.
Absolutely. It's the engine for their disciplined capital allocation strategy.
They've paid a dividend for a long time, right?
Quarterly, since 2004. Very consistent. And just in 2024, they paid out nearly $180 million in dividends, bought back over $300 million in shares, and they still reduced debt by over $100 million.
So returning cash, strengthening the balance sheet, all at the same time.
Exactly. It confirms they're a mature, disciplined company when it comes to handling their cash. That leads to a good 4-star rating for financial strength. Solid as a rock, really.
Okay, so operationally, fundamentally, it seems like a quality business managing a transition. What does Wall Street make of all this? The analysts?
Well, the analysis describes their sentiment as cautious optimism.
Cautious optimism. Sounds a bit non-committal.
It is. It's a nuanced picture, and frankly, somewhat contradictory in places.
Okay.
So the overall analyst consensus recommendation is actually a moderate buy. That's 4 stars. They recognize the long-term quality of the business.
Buy.
But when you look at the revisions to estimates for next year, a fiscal 25, both EPS and revenue estimate revisions have seen downward momentum, and they're projecting minimal growth there. So those only get 2 stars each.
Okay, so they like the company long-term, but they're not excited about the immediate future.
Pretty much.
Yeah.
And adding to that, the price target analysis, it shows only about 2% implied upside from where the stock is trading now.
So they basically think it's fairly valued, no big margin here, according to them.
Exactly. It seems like analysts are in a show-me mode. You know, one decent quarter isn't enough for them to rush and raise their forecasts. They want to see sustained performance in this slower growth reality.
And the valuation is likely key here.
Definitely. The valuation debate is central. You've got a forward PE ratio north of 25x.
Which is pretty high for low single-digit growth.
Right. High single-digit EPS growth is maybe baked in, but it's still a premium multiple. Yeah. Analysts seem to think the premium already accounts for a recovery or that stability we talked about.
So overall analyst sentiment is just neutral.
Neutral, 3 stars.
Yeah.
Sums up that cautious wait-and-see attitude.
Okay, that's the professional view. What about the wider market? Individual investors, traders. What's the buzz out there?
Also pretty mixed. The overall broader sentiment is decidedly neutral, again 3 stars, and Pool Corp is described as a classic battleground stock.
Meaning big disagreements.
Big disagreements, a real divergence of opinion. News sentiment, for instance, is mixed. You see positive headlines when they beat earnings.
Mm-hmm.
But then you see cautious articles popping up questioning that high valuation.
Okay. What about individual investors?
General investor sentiment seems uh, cautiously positive. You often see people framing pullbacks as buy the dip opportunities.
Focusing on the quality angle.
Yeah, focusing on the quality, the moat, the stability. And interestingly, you often hear mentions of Warren Buffett's interest in similar kinds of steady, durable businesses. So that gets 4 stars.
But then there are the traders. And you said it's a battleground.
Right. And trader sentiment, that's significantly bearish. Only 2 stars here.
Why so bearish?
It's highlighted by a really high short interest. Nearly 10% of the float is sold short.
Wow, that's a lot of people betting against it.
It is. These traders are laser focused on the near-term headwinds, the slower growth, the valuation premium. They're betting those factors will push the stock down, at least in the short term.
So you really have this tug of war playing out. Long-term focused bulls who like the quality.
Versus short-term focused bears worried about growth and valuation. And that definitely contributes to the stock's volatility. It explains why it can move around quite a bit.
Okay, let's try and pull all these fundamental pieces together then. We've looked at growth, profitability, financial strength. What's the final verdict on Pool Corporation just as an operating business? Putting the stock price aside for a moment.
Well, the overall fundamental rating based on those core metrics comes out as average, 3 stars.
Average after hearing about the Fortress balance sheet and strong margins.
It reflects that this is really a business of dichotomies, as the analysis puts it. You have these undeniable core strengths, that best-in-class profitability, the resilient gross margins, high returns on capital-clear evidence of a wide competitive moat.
And the financial strength.
And that fortress financial strength, prudent balance sheet, super reliable cash flow that's even stronger than earnings suggest. Those are big positives.
What?
But that's counterbalanced by the significantly moderated growth outlook. The engine has shifted from those new construction booms to the slower, steadier maintenance side.
So the quality is high, but the growth trajectory is just lower now.
Exactly. And the market is grappling with how to value that combination.
Which brings us right back to that core investment question, doesn't it? The big debate is just whether that current premium valuation,
Yeah, the 25x plus PE.
whether that adequately reflects this new reality of lower growth, even considering the high quality and stability. Does the price already capture the good news?
That seems to be the crux of the issue for investors right now.
So, quite a journey we've taken here through Pool Corporation's shift from that pandemic boom
Yeah, those crazy times.
to this more, well, normalized environment. It's clearly fundamentally a high-quality operation. Strong foundation.
No doubt about that.
But it's facing this new reality, slower growth. And that's creating this really fascinating tension in the market, this tug-of-war we talked about.
It really is. And I think this deep dive shows how vital it is to look, beyond just the headlines or the past performance. That 152% cash conversion,
Right.
that's not just some random number. It fundamentally changes how you should probably think about a company like Pool Corp. Lots of businesses, especially ones relying on big projects, they can struggle with cash flow even when profits look okay on paper. But here, that super consistent, almost automatic cash coming in from maintenance, it's like a financial shock absorber. It gives them this incredible resilience, this ability to keep returning capital even when things slow down. It's kind of a blueprint for what a high-quality compounder can look like, even when the market shifts under its feet.
That's a great point. Okay, so here's something to think about. Considering Pool Corporation's really strong profitability and that amazing cash flow, but now facing slower growth, what aspects of a company's financial profile do you think become most important for creating long-term value in this kind of market environment? What should people be focusing on?